Okay. Welcome everybody. This is the Thursday evening Viper trading webinar. If you're here to learn about trading the futures market, you're in the right place. Tonight's topic is one and done trades. So we're going to be focusing quite a bit on how to be patient whenever you're trading, and to just simply look for optimal trade setups to take in the market. And many times, if you time these right with some good entries, most mornings with a little bit of expertise, you can nail a trade or two and be done early, very early, like within an hour or two or less. So, but first we have to get our standard disclaimer out of the way, and then we'll get over some charts. All communications from Viper Trading Systems are for educational purposes only. Futures and Forex trading does involve risk, and there is a risk of loss. Nothing contained in this webinar, other webinars, including the live pro trading rooms, are to be construed as investment or trading advice. And of course, everyone in here does know that you do trade at your own sole discretion. All right, good. Okay, so before we get on to a couple of charts, I'm going to ask some questions, a couple of very quick questions. Just two of them, two or three, and then we'll get over to some trades. The first question is, and I want everybody to make sure we kind of get on the same page here. We got kind of a mix tonight of subscribers, folks that have been with us for a while, some new folks, and then we have some quite a few of you might be on a free trial, or we had a lot of people visiting us this week too. So if you are any of those folks, you're welcome, and we hope that you take something away, that you learn something good from this webinar tonight. Okay, so traders, experienced traders who make a good money in trading the futures market, what would you say, if you were to type in one or two things, are some key aspects in the quest to add money to our trading accounts? What would be a couple of critical things to pay attention to, and one thing that helps most traders make money quickly? It would be another way to say it. Discipline, patience, support and resistance, absolutely. Those are all key critical things. Support and resistance, trend, coffee. That's good. Know your instrument. Good, William. That's right. Know your instrument's been a critical, some folks still coming in here. We're just getting started. Money management. That's right, Jack. That's good. Yep. Keep your exposure to a minimum. Yes, absolutely, Jim. That's good. Keep your exposure to a minimum. So you want to get in and out of the market. Absolutely. Good. Well, I haven't seen this other term, and I want us to think about this for a minute before we get over to the charts. Okay? It's called the principle of leverage. Leverage. Now, when I say the term leverage, what am I talking about as it applies to trading? The term leverage, what am I talking about? What does that term mean to you? Everybody in here tonight. We've got a lot of people coming in here tonight. What does the term leverage mean? When I say that, what am I referring to? What does that mean? Leverage. Good. How many contracts to trade? Buying power. Good. Multiple contracts for multiple dollars. That's right, Jim. That's the principle of leverage. So I've been talking to a few traders, quite a few traders earlier this week on Skype, and this topic came up where a couple of them said comments to the effect of, you know, when I said, well, why don't you look at trading NASDAQ or YM or EMD, and there was something to the effect, I don't remember the exact words, were something like, well, I can't make any money on $5 or $10. How do I make any, these little $5 instruments, how do I make any money? $10? I want to make, you know, I want to make good money. I'm used to making very good money. So, well, this is where the principle of leverage comes in, and this ties in with our whole concept tonight of one and done trades, and I'm going to show you in just a minute what that means. So let's get over to a couple of things here. Let's get over to some charts, and let's get over to some things, some important things we're going to commit to memory. Let me shift to screen 1. Stand by. One and done and leverage. That's the two things we're going to really work on tonight, okay? The 4 steps that we should have committed to memory, and most of you have seen this, but if you're new, maybe you haven't. Determining support and resistance. Determine if there is a trend, and if so, what direction. If there isn't a trend, you can either trade the range by scalping it or stay determined to stay out. There's nothing wrong with that. And we'll look at some of those setups tonight. We're going to take our time to look cautiously and optimistically at good trade entries and where our initial stop will be placed. And then finally, we're going to look for potential profit targets. Try, if you can, to commit these to memory. We're going to go through several charts. We're going to go through each step. Support and resistance is pretty easy to remember, right? Support and resistance. Trading a trend or not a trend, which determines what kind of trade we take. Locate our entry and look for profit targets. Those are the 4 things we need to focus on when we get ready to take trades in the market. So let's start off with this chart right here. I'm going to look at an EMD chart, and we're going to work our way through multiple charts. Now, the first step was what? I took that away like a minute ago. Hopefully everybody's still with me. What was step 1? Anybody paying attention? Hello? Anybody out there? Hello? Is this thing still on? Let's see how many of you actually remember something that was in front of you like literally a minute ago. Hey, by the way, I'm just kidding with you. Don't feel bad, because I'll tell you what, when it comes to short-term memory, I am the absolute worst. Sometimes I got to look at something about 84 times in the span of like 2 minutes to remember it. So don't feel bad. Okay, most of you get it. Okay, all right, trick question. I'll bring it right back. Yeah, first thing is we're going to do when we look at trading, this is A number 1. That's why it's step 1, support and resistance. And let me show you how easy this is to get right on your chart, okay? Support and resistance. Remember, that's number 1, okay? All right, good. Well, let's look at this chart, and we'll do this together. I'm going to start with some easy setups, and then we'll work up to some more complicated ones. Here we can see we have a pretty good swing right up here, right? Hit its head, hit its head, hit its head. So, resistance, right? We can look down here, and we see we have another support resistance. And what I do, most of you know this, is what we do is we start from the right-hand edge over here, and we scan back, and we look for swings in the market, swings in the market, swings in the market. And when we see them coinciding with each other, as in you do right in this area right here, we can call that a support resistance area, yes? For instance here, hey Maurizio, ciao Bella, welcome. Just real quick, here's what we do. We look for where we see a support, and support generally, in most cases, turns into be, or resistance turns into be support, and vice versa. And of course you see down here we have another level of support where it looks like, excuse me, we got kind of a triple bottom maybe down here. All right? Good. Now this is EMD. This is $10 a tick. We're trading the June contract. Most of you know in the equities we're trading all June contracts now. And I'm going to advance this forward, and then we'll go on with our next steps. All right, here we go. Nope, what happened there? We're going into the morning of this, early morning of today. This is Pacific time. I'm here in California. Most of you know that. So this would have been yesterday, and this was today, the 14th. So we're going into early morning. What happened over on the right-hand side of the chart? Between, midnight and about 5:30 Pacific. Yeah, it broke out. Broke out, right? It took out resistance and went up to a new swing. Good. Yeah, it broke out. Pretty obvious. Now, what was step 2? Really quizzing you guys, huh? Guys and gals, everybody in here, what was step 2? It's we got to have a little sip of espresso and get our short-term memories going here. So step 1 was support and resistance, and here you can see we put that on the chart. Support and resistance levels. Support generally becomes resistance, and resistance generally becomes support. Good. Most of you got it. Step number 2 in our trading steps is to determine if there is a trend, and if so, what direction. Right? Or if there's not a trend. That's step 2. So doing step 2, looking at this chart that you see right here, would you say that this market is in a trend or not in a trend? And if so, what direction? Trending or not trending, and if so, what direction? That is step 2 after all, yes? Step 2. Good. It's trending up. And most of you know the obvious, I'll just state it. Trending means higher highs, higher lows, lower highs, lower lows. And you can see that pretty much we were in an uptrend, like such. Connect some swing lows here, and you can see that the uptrend. Now, after we push through this swing high here and put in another swing high right in here, and the market starts to pull back in the trend, where might the market find support? Here we broke through. All of you typed in that we're in a trend and it's up, and you're right, we are trending up. There's no question about it. We've broken through. If the market pulls back here, where might it go to? Look at the chart for a second. There's some logical places where the market might retrace to. This is very critical. This is probably the most critical part of the whole trading process. We did step 1, support and resistance. We did step 2, it's uptrending. Step 3, locate trade entry. Good. All right, most of you have said, and this is perfect, this is what the whole crux of this webinar tonight is about. You've made note of the fact that we had a pretty strong resistance area right in the 34, 34.50 area right in here. We checked it here. We checked it here, and we broke through it over in here. All right? So somewhere in this area of 34 to 34.50, which almost everyone here has typed in, that if we're going to retrace and the market dips into this area right here, that I think we all would agree that it would present a potential buying opportunity for us in the uptrend. Yes? Good. Perfect. All right, we all see that. Good. Perfect. Excellent. Now, I'm going to advance this chart, and we're going to notice what happens on these bars. I'll blow this up so we'll all look at it, right? What happens on these bars right here? What do those bars do? They turn yellow. We're retracing after our push up to a fresh swing, and they're pulling back into our buying zone. So for instance, when you're in the live trading room and you hear somebody in the live trading room say something like this, and ideally what would happen as time goes on is that we will all learn to see these levels ourselves, right? As you get more experience and you get more trading under your belt and you do this more and more on charts, support and resistance and trending, that you'll start to see these levels yourself. It's helpful in the room when somebody says something to the effect of, if I see EMD pull back into the 34, 34.50 area, prior support resistance with a swing and or a pivot, I'm going to be looking to buy there. That's what that person is referring to. This is precisely what we're talking about when you see that. A market that is trending, has broken out, and is retracing. So what we do in a trending market is that we want to buy or sell retracements at support and resistance areas. Okay? And that's part of this step right here, step 3. Remember, step 3? Locate trade entry and initial stop. And the critical part of that, of course, is to, if you are trending, is to look for those retrace. Oops, what did I just do there? Oh my goodness, I messed up my whole thing. Stand by. What did I just do? Oh my goodness, I messed this whole thing up. I can't believe I just did that. Hey, what did I do? Everything's shifted to the right. I don't know how. I don't have any idea how I just did that. But anyway, you can see step 3 is right here. Locate trade entry and initial stop. trade entry and initial stop. Here we can see that we pull right back into our support area that everybody said this is a potential buy. Now, you can see that there is a swing here and there's these dots. See the dots in the little swing level? So if you were going to buy here, if you're going to go ahead and put a buy order in here, do I have Chart Trader on here? Am I in Sim? Yeah. Okay. All right. So what we want to do is we want to put a buy order in here. Am I connected? I am connected. Why is it not letting me buy here? I want to put a buy order on here. It's not letting me do it. That's very strange. All right. So let me just put it right on here. Okay. Now we dip down into our buy zone, and we can see that below here we have these lines and these dots. These represent where your initial stop would go. So you're going to be buying support, and just below there is going to be your initial stop. That's right. The yellow bars are probing for support. Here we can see that on this little sequence of bars right here, that we pierced the retracement line. So in other words, we came down, we dipped into our buy zone, and we're long. Say anywhere from 34.10 to 34.50, you would have bought and gotten long right in here, and your initial stop would have been right down in here. Right in here is your initial stop. Does everybody see that before we move on? I want to make sure we all see this entry. Does everybody see the trade entry, why we bought there? Anybody not see it? Does anybody not see why we bought right in there in that yellow bar probe and an uptrend right into support? Okay, good. Excellent. We're long. All right, we're long. Let's see what happens. We go up. We take out the swing high at 36. We continue to head higher. It struggles a little bit there and then punches up through it, punches up through it, punches up through it. And we hit, and now here's another technique of exit. You can take an uptrend line and you can extend it up here like such, approximately at about a 45-degree angle. So what's going to happen is as a market moves in your favor in a trade, you're going to see a series of moves like this. It's going to come up, pull back a little bit, come up, pull back a little bit, come up, pull back a little bit, up, pull back a little bit. And then at some point, after it's done moving in your direction, it will break through this little uptrend line. And what you could do is you could take your trailing stop, and I don't know why this is not letting me put a stupid trade on here. This is the only chart that's not doing it. I can do it on all the other charts. Anyway, what you would do is trail your stop, trail your stop, trail your stop. Now watch what happens here. Right in here, you can see that on this bar, this uptrending line is taken out. This is where you would have been stopped out of the trade. So the trade would have entered between 34 and 34.50 long, and you would have exited the trade a few ticks under 38. Right in there. That was the long trade right there. Now this trade, you would have been filled shortly after the market opened. The market opened at 6:30 Pacific for the equities, 9:30 Eastern, so you would have been about maybe 6:32, 6:35, about 5 minutes into the market open. And right here, just shortly after 7 o'clock, so you were in this trade a total of about a half an hour, plus or minus. How much money did you make on the trade? Well, let's say you got filled at, I don't know, 30, let's use some round numbers. Let's say you just got filled at 34, 34.10, and you got out at 37, I don't know, 70. Here, let's do some quick math. So you got out at 37.70, you got filled at 34.10, so that is a total of 36 ticks. And how much is EMD? How much is EMD worth per tick? Anybody remember how much EMD, this instrument, is worth per tick? Let me just show this here. So we bought in here. Our initial stop was down here. Oops. While you're doing that quick math calculation, this is your initial stop. Right, done in here. And then here is where you exited the trade, up in here. So shortly after the open, you got long, and you held it till a little bit after 7. So you're in this trade about a half an hour, roughly. There's your exit, up in there. Yeah, $10 a tick, exactly. Okay, EMD is worth $10 a tick, and we said this was approximately 35, 36 ticks, this long trade. So this trade on one contract was worth how much? per contract. You do the math. Let's just use some round numbers. Let's say it was 35 ticks. You know, it could have been a little more, you know, depending on your fill and your exit. It could have been a little less. You know, it could have been 34 or 32 or 36. I'm just going to use a round number, and I'm going to say that one trade this morning that you were in about half an hour was worth around $350. Now, Lars has already typed in where I'm going with this. When we opened up this webinar, and some of you came in late, so it's okay. What was the other thing that we talked about? What was the couple of critical things we have to remember? And we all talked about support and resistance, locating the entry, but what was the other principle which we have to realize that we're going to take care and how most traders make money in the market? Leverage. Leverage. When we say the term leverage, we're talking about how many contracts to put on here. So we can quickly do some math. And we can say that if we had put 2 contracts on here, we would have made $700 on this trade. Now, you have to realize that the principle of leverage works both ways, okay? We can't just say, oh, well, I'm going to only look at the upside, and, you know, you start doing some quick math, and you say, well, if I put 4 contracts on, I could have made $1,400, which is true, right? If you put 4 contracts, you can make $1,400. But now I want to be clear about something, okay? When you bought in here, you bought in here. This was our buy, right? And you put your initial stop down here. So this establishes your initial risk. Let's say your initial risk was, you know, I don't know, 6, 8, 10 ticks. So when you put more contracts on, if you put 2 or 3 or 4 contracts on, in the anticipation of making more money on your one and done trades, you have to realize that you're doubling and tripling your risk, right? So if this initial risk down here was, let's use a round number, let's say 10 ticks, right? This was your initial risk, might have been 10, I don't know, let's just use a round number, 10 ticks, which equals $100 of risk. Yes? This is your initial risk that we're talking about down here when you get into the trade. So you have principle of leverage. It works both ways. You stand to make double or triple the potential gain depending on how many contracts you decide to trade. But the flip side of that is that if you lose, now you're, instead of losing $100, you'll lose $200, $300, or $400. Okay? Everybody needs to realize that leverage can bite both ways. So when you're looking at the principle of leverage, it's a function of the size of your trading account. Generally speaking, in the course of a morning or a trading session, you don't want to risk more than about 3 or 3.5% of your account. So you can quickly do the math. You know, if you have a more modest account, like $5,000 or $10,000, you know, your trading risk is going to be fairly small. You're not going to be able to risk more than what? A couple of $300-400 in a morning, right? So putting 5 contracts on here might not be in the cards. Does everybody follow that? It's a function. Now, if you have, some folks have larger accounts, and you're going to have 50, 100, you know, 200,000 in your trading account, and you can do the math accordingly. The larger the account, the more risk you can afford to take, and that's where leverage comes into play. So that's the rule of thumb. 3 to 3.5% of your account in a given trading session or morning, or if you trade the currencies in the European session, that's how that all works together. Does everybody see that? That's a one and done trade right there. One and done. If you learn your instrument and you get comfortable trading your instrument and you know generally how it moves in a trend, how far it's going to move, how far it's going to retrace, where the support and resistance levels are, you know, where you should be taking profits. You want to do another one? You want to see what happens on this chart? This was the first trade. What's the first step? What's step 1? Going backwards now. I'm going to do this so we all get it ingrained in our heads, right? What is step 1? Everybody remember? You late birds might not remember. If you came in late, that's okay. Step 1 of our trading, when we trade, what is step 1? Numero uno. I'll remind you, determine support and resistance. Now, where this comes into play, this determine support and resistance again, is, I'm going to show this here, okay? Support and resistance. Here we had in the pre-market session, before we took this trade, located support down here, support and resistance here, and support and resistance here. Now that the market has moved 40 ticks up, is this support and resistance all the way down here particularly relevant to where the market is now? Well, we can see, I can see a potential new support resistance area. Where might that be located on the chart if you're going to put that in on this chart? Where would a new support resistance area go? I can see one. I see one pretty clearly on here. Take a look at it for a minute. Where would a new support resistance level go on this chart? Let's go ahead and type in a number. Remember how we identify support and resistance now, right? Remember how we identify that. We start on the right-hand side of the chart and we scan our eyes backwards and we look for swings. We look for coinciding of swings, and we're going to put a line there. If I'm going to put a line, wow, most of you got this. Okay, good. All right, okay, most of you typed in right around the 36 area. Good. Now, there's no mystery to this, okay? And this is something you can just take a few minutes on your chart and you can do. And this is all I literally do. Like early in the morning or throughout the course of the trading day, I just simply look for things like this. I just look for like where a market came up to and like been pulled back from. I look for where a market came up to and consolidated for some short period of time. I look for where these little swings coincide with each other. And then I just put a line there. 36. Yeah, right in plus or minus if you said anywhere in this area right here. Now, if and when this market starts to retrace, where might it go to? If and when this market starts to retrace, because we all agreed that we're in an uptrend, right? I think everybody in here agrees we're clearly in an uptrend, right? We all agreed that. If the market pulls back from the swing high of 38.40, where might it go to? Now, as you're pondering and thinking about that, we are talking about step 2. Step 2 is determining the trend, which we did. The trend is up. And step 3, which is locating potential trade entries. So when we say the terms, where might the market go to, what we're actually saying is step 3, locate the trade entry, yes? That's actually what we're doing. Most of you know that, but I'll just state the obvious. That's actually what we're doing when we say, where could the market go to? And perhaps more importantly, if and when the market does that, what are we going to do? I think this is where I see a lot of traders really struggling, right? A lot of them can, most of you can find the support and resistance levels. You're pretty good at that. Almost everybody can see if there's a trend or not, right? I think this step 3 is where I see a lot of traders start to really struggle a little bit in this locating trade entry. So when you're locating the trade entry, what we're doing is we're saying to ourselves, hypothetically, if this market was going to retrace, where might it go to? And more importantly, if and when it got there, what would I do? Now, most of you have typed in the following. Most of you have said that quite possibly it might retrace into here, this 36 area, and this might represent a potential buy area. It would be right in the area of the uptrend line. It would be right in the area of prior swing support resistance levels. And since we in fact are in a trend, we would look to buy this area, yes? Does everybody see that? That's the critical step 3. We're locating potential entries. We have to look out ahead and project and say, if the market pulls back, where might it go and what am I going to do? So here we dip down, here we dip down, and here we came right into, I think, here, where did this swing down into? Got all the way down to 36.30. Didn't quite get down into this 36 area right here. So the way you do that, and we all know this, but I'll just show it, we draw a retracement line. We have a yellow bar probe, and the retracement line, 45-degree retracement line, was broken right in here, on this candle right in here. That was the long entry. This is where you would have gotten long. It pulled right back within a few ticks of our support area here. On this retracement, you draw the retracement line. There's whole entire webinars dedicated to retracements and how to draw this line. I'm not going to go through the intricacies of that right now, but most of you know that you're going to draw a retracement line just like you did over here. And when it's broken to the upside, at or near a support level, you're going to buy. So this was your second buy area right in here. This was the second long entry. If in fact you decided to take it. Maybe you didn't. Maybe you already took that trade and you were done. Maybe you missed this trade. Maybe you missed all this over here. Maybe you didn't get anything and you're sitting here at 7:30 and saying, where am I going to get in? You could put a buy limit order in there. It might have been hit. You could have hit market buy. There's all manner of ways to get in here. Your initial stop would go beneath the swing here, just a couple of ticks below 36. So this would have been your initial stop. And that establishes your initial risk, right? Your initial stop is right here. So now we've completed step 3. Step 3 was locate potential entry. And now we're going to locate potential profit. Step 4. Now if we know our instrument, we get a pretty good idea of how far it moves before we get a retracement. And the other thing we can do is we can draw some uptrending lines like this, and when they're broken, we can trail our stop up and get out. Let's see where this market goes. Excuse me. Excuse me. There's a couple of ways you could have managed this trade. You got a little pop up here, and it might have taken you out just under 39. Or if you trailed the stop on the trailing stop dots, you see that we got kind of a double, triple top up here. Either way, I'm guessing you probably would have exited somewhere under 39. You know, probably somewhere in here would have been your exit. So you got filled at, what was it, 36.50, and it popped up and maybe gave you 38.50. 36.50 to 38.50 is how much? About 20 ticks? You know, plus or minus 20 ticks. $10 a tick. This second trade would have been worth about $200. You know, plus or minus, depending on your entry and exit. On one contract, trading EMD with two long trades today, you would have made somewhere between $500 and $550 on 2 trades. How many of you would be done trading for the day? For some of you, that might represent your profit goal. I don't know what your profit goals are, but for the day. But you know, some of you might have hit your profit goal on one trade here. That would have been one and done. Some of you might have just hit the second one. 200 might be enough for you. Some of you might have caught a couple of them and been up 550. 2 and done. And of course, you can do the leverage calculation. You can say, well, if I took 2 trades, 550. If I put 2 contracts, I would have made $1,000 for the day. I think most traders would have been pretty happy with a $1,000 morning. CJ, yes, the steps. We're just going to recap the steps one more time, and then we're going to go on to another chart. So everybody's on board here. Step by step. Step 1. We're going to commit these to memory. You can write them down if you want, but these should be in your memory. You should just automatically know when you look at a chart what to do, step by step. And you know, in the beginning, it's okay. If you're learning the basics of these trade entries and exits, it's perfectly okay to write down the steps and follow those each day until they're committed to memory. We're going to first determine support and resistance. That's where these lines are right here. Support and resistance, right? Support and resistance. That's a critical first step. Step 2, we determine if there's a trend, and if so, what direction. If there is no trend, we look at the trading range and we decide whether we're going to trade it or stay out. That's step 2. Step 3, we locate the potential trade entry and where an initial stop might go. So when we say the words, if the market pulls back into the 36 area, I'm going to look to buy, then that means that you're looking for a retracement into a support resistance area and you're looking to buy. If somebody says, I'm looking to buy between 34 and 34.50, there's a critical swing there, I'm going to look to get in long, then that's locating the trade entry. That's what you're actually doing is step 3. Okay? And step 4 is, if you can, locate a potential profit target. And there's 2 ways to do that. If you have pivots on the chart, sometimes trading pivot to pivot provides good targets. Sometimes the pivots are wider, sometimes the pivots are closer. It really depends on the function of the volatility. But you can use pivots as targets. The other way you can do it is you can try to get a sense and a feeling for how far your chosen instrument moves before it retraces. You might watch an instrument, you might say, you know, I've noticed that when it moves between 20 and 25 ticks, generally it's going to retrace half of that, or about 10 or 12 ticks of it. Or you might notice an instrument tends to run about 30 ticks, and then it retraces 15. This is where we get into the concept of knowing your instrument, picking 1 or 2 or 3 instruments on your screen, and then really learning how they move and get in sync with it. I've said it over and over again. Trust me, that's going to help you make money. Satan has typed something in here. I came in late. Okay, 550 sounds like I would have been done. I can't even make 50 bucks. Well, Satan, what you're seeing here, is that helping? I don't know if that's helping. The steps that we're talking about and the support and resistance in a trend. I don't know if that's helping you. It's helping. Okay, good. All right, good. Let's look at another one. Let's look at what the Russell did today. I have quite a few more to go through, and I've only got about 20 minutes left, so I'm going to have to step it up a little bit. How do we know if a market's going up or down? 6E. You want to look at 6E. Okay, we can look at 6E. Let me ask CJ's question. Maybe the team can help answer that. How do we know if a market is going up or down? Anybody have an answer for CG? Anybody have an answer for CG? How do we know if a market is going up or down? When you look at this chart, can you tell if the market is going up or down? Most of you are typing in higher highs and higher lows. Higher highs and higher lows. Let me give you some very simple way to know if a market is going up or down, okay? There's a very simple way to do it. It's very, very easy. What you do is you come down when it appears that a market might be trending up, and you take this tool right here. I want everybody to try to remember this. It's really, really easy. You're going to take your ray tool, okay? You're going to come down to some lower levels where the market is putting in swings that appear to be higher and lower. As you see right here. You're going to put the bottom of the ray here, and you're going to extend the ray up through a couple of points here and here. If and when the market retraces back down into those areas, that represents buys in an uptrend. Those are buying retracements in an uptrend, higher highs and higher lows. The other thing that visually can help you, can you see how these dots and these lines are exhibiting stair-stepping behavior? Doesn't this look like some stairs going from the first to the second floor or the second to the third floor going up? Visually, you can just simply see the fact that the market is trending up, yes? The backdrop is green. Yes, that's another way to tell. The backdrop is green. The market, generally speaking, when the background is green and you have blue bars and the stair stepping up, this is indicating you're in an uptrend. Let's go back and look at a couple areas. Here, we'll look at another one. Let's look at another one. What direction would you say this market's heading in? Well, how do we say we're going to do that? We're going to take our ray tool, right? We're going to connect some lower levels. And I like the ray because the ray extends out into the future. You don't have to keep extending it. It just extends on out until, until it breaks down through it. Can you see here that each time the behavior that will be exhibited in an uptrending market will be as follows. You will see a thrust in the up direction, and then you will see a retracement or a pullback into support levels. These pullback and touch points in an uptrend into support levels represent buy areas. These are all buy areas. Sometimes the bars will turn yellow. That's called a yellow bar probe. Sometimes they remain blue in an uptrend. That's called a regular bar probe, when the bars remain blue. That means regular bar, meaning they haven't changed color. Yellow simply means that they're pulling back a little further beyond a particular support or area, and that's why they turn blue, yellow. That's why they turn yellow. If you don't get much of a retracement and they just pull slightly back into support, they will stay blue. Although, even when they do, this still represents a potential buy. We're buying support, we're taking profits at resistance. We're buying support, we're taking profits after it moves 20 ticks. We're buying support, we're taking money off the table after it moves 15 ticks. We're buying support, we're putting our initial stop down in here. See these lines? Each one of these lines where we're buying support, we're going to put our initial stop down here underneath. That's how we're buying in. That's step 3, right? Locate potential entries and stops. Locate potential entries and stops. Entries and stops. Let's look at another market. Somebody want to look at 6E. Let's get a 6E chart up here. Stand by. I have that on another screen. In fact, I'm gonna set this chart up and we're going to do a quiz. Ready? I'm going to pull this chart down and we're going to do a quick quiz, and we're going to make sure everybody's on the same page here. Ready? Here comes a 6E chart. Excuse me. Give me 1 second. I'm going to drag it over and we're going to do a quiz. We're going to ask some questions. Is everybody ready? Okay, here comes the 6E chart. Let me scrunch this down, show our steps, and I'll pull down the 6E chart. Here we go. I want everybody to learn these patterns tonight and start to try to commit this to memory, okay? This is how you're going to put coin in your trading account. All right, I'm going to drag this chart down. We're going to look at a very specific setup. Ready? Here we go. All right, can anybody describe to me what's happening here? Just take a minute. Type in what's happening. What's going on right here? Good. Let me help you out while you're looking at this, okay? This is what we're all going to work on together as a team. Right? Step 1, support and resistance. Here we had some support, here we had some resistance. We were in kind of a consolidation area for a little while. This is going into earlier today. We were in consolidation. Obviously, everybody can see that it went into a downtrend. Everybody sees that. We double bottom down here, right? Everybody sees we double bottom down here. We come back up to check this resistance area right up in here. All the way back up in here. Come all the way back up in here. Oops, I'm sorry. We punch through it just slightly right in here. And then what do we do after that? We punch further up through resistance over in here. Now, good, most of you have typed in the following. This is a trend change. This is a trend reversal. How do we know that? Well, let me put it to you this way, and here's the best way to look at this. If this market was going to continue down, and it did a yellow bar probe all the way up into here, and you drew a retracement line like such, that you were looking for a break to the downside to short, right? When it came right up into here and it hit this area, should not this market have rolled over at that resistance level and broken down, giving you a short and a trend continuation to the downside? Yes? I think we all would agree that would have been a shorting opportunity if it rolled over here on a yellow bar probe. We all see that, yes? Everybody sees that. But is that what it did? Did the market do a yellow bar probe here and roll over, giving you a short at resistance? Did it break this retracement line, yes or no? No. Now, when you see this happening in real time on your chart, this is the first clue that a potential trend change is afoot. The second clue is that it takes out some key swing levels and now pushes up to a fresh high like this. The third clue that a trend changes afoot is it pulls back, establishing a higher low. Now you have the ability to come in here and use your ray tool to do what? We just said it on the other chart. What are we going to do when you see higher highs and higher lows? What's the first thing we're going to do when you see this type of behavior on your chart? You're going to take the ray tool and you're going to put an uptrend line. Yes? We're going to connect these dots like such. This did not happen. We are clearly going into an uptrend. Now that we have punched through up to a fresh swing high, and now we're going to do step 3 together. Okay, the whole team, everybody here tonight, we're going to do what? We're going to do step 3 together. What is step 3? If this market retraces back to where, what would we do? That's another way to phrase step 3, yes? If the market retraces back to where, what would we do? That is step 3. Looking at the 6E chart right here. Think about it for a second. Just look at the chart. It's right there in front of you. If the market pulls back to where, what would we do? Go ahead. I'll just give you a minute. Type it in. Look at the chart. It's right there in front of you. Think about it for a second. Just look at the chart, because what we're doing, these exercises tonight, is what we need to do tomorrow and next week with our trading. These things that we're doing are going to help your trading. That's why we're doing them together, okay? Good. Most of you have typed in the following. You have said that you've typed in numbers, the whole team. Good. Excellent. You've said that if the market pulls back into here, around the 40 to 41, 45 area, in this zone, around this prior support resistance, and where it broke out from, that this would represent a buy area, yes? This is really important. This is probably the most critical thing of what we're showing here tonight. I mean, of course, aside from, support and resistance and the trend lines, those are all important, of course. But we have to be able to see these entries. This is where the rubber meets the road, is step 3, right here. You've got to be able to train your eye to look for those entries and where your initial stop might be. You know what? If you just did that, I would say all these are important. Support, resistance, trend, entry, profit. Okay, all 4 are important. But if you were going to put a weighting on any one of them, number 3 would pop to the top. Because let's face it, excuse me, I'm going to sip of tea. Hold on a second. I think we all would agree that if we can't see the trade entries, that maybe some of the rest of this doesn't matter, right? I mean, we could be the best support and resistance people in the world. We could put lines all over this chart, right? We could see a trend coming from a mile away. That's great. Maybe we can see other things too on a chart, but if we can't see where to get in, then we're going to be, it's going to be a hurdle for us. We've got to focus on getting very, very, very good at step 3, locating those high probability entries. Because if you want to do one and done trades, you want to do two and done trades where you pop in and out, get your 20, 30 ticks, get your 15 ticks, get 10 ticks. You're going to have to be able to see these entries. Okay? All right, well, let's see what this market does. We've located a potential entry area right here, and we've said if we dip down into here, we're going to buy it. Yes? All right, here's the market retracing. Market is retracing. Market is retracing. And I'm going to draw a retracement line. We all know how to do this, yes? 45-degree retracement line. We all need to learn this skill because it helps with the trade entry. Here we can see the market retraced. And right in here, now I put this box in there before we looked at it, yes? And all of you typed in that number. You said anywhere between 40, 41, and 45 would be a buy. That was this box you told me to put in here. And it came right down into where? Where did it come right into? And what will we be doing in here? Yeah, it came right into our opportunity zone. So we'd be buying. Right there. We'd be buying it. Good. Now, before we follow this trade, where is our initial stop going to go on the buy? Where would our initial stop go on this buy? We're filled at 29.44 long on 6E. We're long. It came down, it dipped in, came down here, touched this area, bounced out, and now we're long, and the market's moving up. Where was our initial stop? Okay, I'll help you with it. Right in here, you can see that there was another swing area located down by this 35 area, yes? Right? See it? See the swing area down in here? Everybody see it? You're going to go just a tick below there. You're long, so you put a protective sell stop down here. Now, here's how we manage this trade. Does everybody see the initial stop? This initial stop establishes your initial risk, okay? You got filled long at 44. Your initial stop is at 35. You were risking 9 ticks. 6E is $12.50 a tick. You're risking about what? About $100 plus or minus, yes? You're risking about $100 on this trade. If it flipped over and break down and take the stop out, you lose somewhere around $100. 9 ticks at $12.50, okay? Now, here's a tip. If you've seen other webinars, you know this. Can you see how this market very quickly bounced off of the support area and popped back up to resistance like this? Can everybody see that? Now, when you see this type of behavior and a market starts to move very quickly in your favor, what's the first thing we're going to do with our initial stop? Follow along with me, James. What's the first thing you do when the market pops in your favor? What is the number one thing you're going to do when this market moves in your favor? The number one thing. Aside from finding the entry, this is probably the second most important thing to remember. Get your stop up immediately to break even. Take contracts off. Okay. All right. Well, you know, here. Okay. So 34 to 60, it popped 15 ticks. Okay. Good, James. You might be taking profits of 15 ticks. It hit a swing. I'll give you that. But the other thing we got to do, of course, if you take profits, obviously, you're going to take your stop off the table. But immediately, you're going to get your stop up to break even and then some. Because if it pops up here and you don't take the profits, it could reverse and come back and take you out. Break even or slightly above or below, yes. Now you're in a no-risk trade. By the way, and most of you know this, if you had 2 contracts on here, you could quite possibly be taking profits on one contract up here, as James suggested, which is good. You're taking money off when you're up 15 ticks at a clear resistance area. And then, of course, you would trail the stop on the rest. Everybody see that? Yeah, you're reducing your risk. That's exactly what you're doing. You're reducing your initial risk because now you have a free trade. Good. All right, well, let's see where this market went. Here we can start to draw our uptrend line where it was starting to move up. We see we push up into this 29.72 area. We pull back a little bit. Maybe you held it through that. Maybe you didn't. You know, if you didn't, you might have been taken out here somewhere around maybe, I don't know, 29.65, 66, kind of right in there possibly. So the trade set up at 44, and let's say if you didn't bank the profits at 60 and you got out at maybe 66 or 65, how much was this trade worth? It's $12.50 a tick. Well, let's do the math. Let's say you got out at 66 and you got in at 44. That's 22 ticks times 12.50 is what? 22, about 260, 250 maybe, plus or minus. You know, depending on where you got filled down here and where you got out up here. I don't know. Call it 260 bucks. How many of you would be happy with $260 and be done? That's what one and done is all about, by the way. That's what one and done is all about. Finding a trade or two, taking your profit. You never go broke taking a profit, right? Getting in, getting out, banking your money, and then going into sim or going to get some breakfast or play some golf or tennis or whatever you want to do. That's what one and done is all about. It's not about sitting in your chair trading all day and all morning long, looking for every trade that comes along. That's not what trading is about. Now, here we can apply the principle of leverage again. If you put 2 contracts on, You would have made somewhere around 500 bucks, 520 bucks. Now, but there again, you got to remember our risk. Our risk was about $100 down here, wasn't it? So if you double your contracts, you're doubling your risk. So your initial risk on one contract was about $100 if you'd been taken out. If you double that and you put two contracts on, now you're doubling your risk. And remember, we discussed that your risk is a function of the size of your trading account. You should really never risk more than like 3.5% of your account in a trading session or a day. So you do the math with your trading account. If you have a larger trading account, you can put more contracts on. That's what that comes down to, the principle of leverage. If you have a more modest or a smaller account, you have to build that account up to be able to handle the additional risk. So that's what the principle of leverage is. It comes with additional risk. It potentially comes with additional profit. Now, I would say that you would not start to apply the principle of leverage, and what I mean is putting two or more contracts on a trade until you build up a good history with that trading instrument. 6E, dollar index, EMD, NASDAQ, the Russell, crude oil if you want to take your chances with crude oil. You've got to get some winners under your belt, and you've got to get a good confidence level and have the capital in your trading account to accommodate the additional risk. Does everybody understand that? That's how you do it, Noe. Yeah, those of you who are trying to determine when do I go to two contracts, it's a function of the size of your trading account and how much risk you're willing to take on those trades. Does that make sense? All right, good. You want to look at one more? We're beyond 6 o'clock. I should probably be wrapping up, but I think I had another chart. Want to do one more? And then wrap, or you want to call it a night? I got another chart teed up here if you want to. All right, I'll do one that's not. I'll do one more that's not too hard. All right, one more. We'll do one more that's not gonna be too hard. I'll actually set it up. I'll actually set it up for you. It won't be too hard. It'll help you see this principle that we're talking about here. Okay. Excuse me. Ready? I'm going to bring an oil chart down. Okay? Here we go. We're going to do this together, and this will be the last one of the night. All right. Let me do it this way. Here we can see, and I'll just do this very quickly, and then we'll look at the trade setup. Here we can see we were consolidation area overnight. This is crude oil today, okay? Here we can see we went into a downtrend, like such. Once again, we can see that we put in a triple bottom around the 92 support area. And I'm certain if you look back further on this chart, 92 is probably a support level from somewhere back over here. But we're not going to get into all that right now, okay? Anyway, the bottom line is it bottomed out down in here, right around this 92 area. We can see that we also had a couple of support and resistance areas that had formed right up in here. We also made note of the fact that the market had come down and after the triple bottom had punched up through some critical resistance levels up to fresh swing highs and are now doing what? After we punched up through here, the market is doing what? Retracing. Where might this market go to? What are we doing? We're doing number 3 again together, right? As this market retraces, where might it go to? And when it gets there, what might we want to do? Look at the chart. This is critical step 3. We all agree we've done our support and resistance. We looked at potential trend. We've identified the fact that we're putting in higher highs and higher lows. This is a trend change, yes. We're now in a yellow bar condition, retracing after a trend change. Where might the market go to? If and when it gets there, what are we going to do? I'll just give you one more minute because we're going to wrap after this trade, okay? Look at the chart for a minute. Where might it go and what are we going to do? We all should be able to type that answer in right now, tonight. We've done like 3 or 4 or 5 of these together, right? Most of you have typed in that if it dips down into the 92.20 area and finds support, more or less anywhere down in here, that we're going to look to buy it. Good. If you look down in this area and or a retracement line break, okay, I should put that caveat in there because we've seen cases where it will dip down within a tick or two of that area and you miss a very good trade. The way you avoid that is you have both. You should have, by all rights, your retracement line, and you should have a very clear picture in your mind on where you want to buy or sell a market, yes? Let's see what happens. Retracing, dipping down, dips all the way into our opportunity zone, right in here, and then it breaks back up through the retracement line. So you had 2 opportunities to enter long on this trade. The first opportunity zone was, most of you typed in 92.20. You're buying that area, right? 92.20. Most of you typed that number in. Good. So if you don't get filled there for some reason and the market bounces up and takes out the retracement line as it did on this candle, this is also a perfectly acceptable entry right in here. Does everybody see those 2 long entries on this retracement? I want us all to agree tonight, if we can, before we leave this webinar, I want us all to agree that this step 3, this critical step 3 of locating the trade entry at support and resistance levels or swings or pivots is something that we're all going to work on in the next few days and the next week. Can we all agree to that? Let's make a pact together, okay? A pinky swear. Let's all agree we're going to work on this. I think most of you can see, everybody here tonight, that this is an important critical step to trading. You got to, in your trader's eye, you've got to be able to see these areas. This is where the rubber meets the road. This is where your trading is going to make a difference, I'm telling you. All right, so you're long. You're long from one of these areas. We pop up, we come up through the swing, we push up, we get all the way up to 55. Draw a little uptrend line here if we want. And then you probably got taken out, I don't know, probably somewhere around this 92.50 area. You know, probably somewhere right in here you got taken out of the trade on a stop. You know, somewhere in there. Get taken out on a sell stop. So you got filled, I don't know, let's say, you say 20. Let's just say 20 is a round number. 20-ish, 20 to 25, 27. You're long. Excuse me, and you got taken out at 50. How much was this trade worth? Approximately. You know, from here to there. $10 a tick. Crude oil is $10 a tick, just like EMD and the Russell, TF. $10 a tick. You got filled at 20-ish, and you got out at 50-ish, right in here. Yeah, plus or minus about 30 ticks. Or about 300 bucks. On crude oil, $10 a tick. That would have been about somewhere around $300, depending on where you got filled in the buy and where your exit, where your stop got taken out. But approximately 30 ticks, or around $300 on that one trade. The trade triggered around 6 o'clock Pacific, which is right around the crude oil pit open, and you were only in the trade about 10, 12, 15 minutes. You made 300 bucks. That would be a textbook case study in one and done. 30 tick pop up, 300 bucks per contract, 15-minute trade. Yes, Ken, this is today's chart. Everything I showed you was today. EMD, the Russell, 6E, and crude oil. Everything I showed you this morning was from today. This is today's trades. You can do one and done. It's possible to do one and done, two and done trades. They come along every single day. Well, all I'm trying to simply illustrate here is that you don't have to chase the market around. You don't have to take 5, 10, 15 trades to make money. You don't have to chase the market all over the place. You can just be very comfortable and cautious. And if you say to yourself, you know what, I'm going to be really cautious. I'm going to make sure I'm going to look for a good trade or two. And when I see it, and it fits my entry criteria, I'm going to step in, I'm going to buy it, put my stop in, I'm going to trail the stop, and when I pop up and I get my 20, 30 plus ticks, one contract, and I'm going to get very good at doing that every morning. I might be in a trade 15 minutes. I might be in a trade 30 minutes. I might be in a trade a whole hour. It doesn't matter. But when I get my profit, I'm going to bank the coin, and I'm going to stop trading. We all can try to work on these 4 steps. We know them, right? Support, resistance. Is there a trend or not? Let's just boil it down to 3 or 4 words. Support, resistance, trend, entry, profits. Support, resistance, trend, entry, profits. Just remember those 4 or 5 terms and apply them to your charts. And if you do that systematically each day, and try not to shuffle between instruments. Okay, that's another thing I talk to traders all the time. You got a crude oil chart over here, and you got 60 over there, and you got a Russell chart, but then you pull a NASDAQ up, and then you go look at EMD because somebody made a comment. Shifting around between instruments in the course of a trading session is going to make it really hard to do these one and dones because you're not going to be focused. Simplicity sometimes is better. And if you can get it down to 1 or 2 or 3 charts, a lot of times that's better than having a lot of charts and chasing the market around. Yeah, Jim, crude oil sometimes follows waves. I mean, here you can see that here we had a push up. I'm guessing this is probably about 30, 35, 40 ticks. Here we pull back deeply. Here we pushed up about probably 40 ticks here total, from top to bottom of the swing. Here we pull back about 15 or 20. When these markets are trending, they're going to follow those patterns. They're going to have a push, you're going to have a retracement. You're going to have a thrust, you're going to have a retracement. Or if it's not trending, of course, it could be range bound. And then you have to decide accordingly whether you're going to trade the range. That is part of step 2. If there is no trend, you have to determine if the range is large enough, and our criteria is 20, 25 tick minimum to trade it. If it's smaller than 20 or 25 ticks with slippage and commission, a lot of times it's not worth trading it. One and done trades. I got to rock and roll. We're here at 6:15. I'm going to stop the recorder. I know with questions we could probably go all night.